If you own multiple companies, properties, or investments, you have probably asked yourself how to protect them better or to make ownership simpler. Holding everything in your own name can become risky and hard to manage, and it can expose your assets to legal issues like lawsuits, divorce, or creditor claims, especially when you are dealing with cross border rules or thinking about succession. In this video, I'll explain what a holding company is, how it works, and why more business owners are using it, especially in places like Dubai, to protect their assets and plan ahead. Before we start, my name is Shiraz Wahid and I'm the co-founder at Leopardus World, where we have helped many of our clients and families with trust, foundation, and other asset protection strategies in Dubai. If you would like my help in doing the same, you can apply for a free and customized asset protection plan by clicking the link in the description below. A holding company is a legal entity that does not directly engage in business operations. Instead, it owns shares or assets in other companies. Think of it as the parent while business underneath are subsidiaries. It's a strategic layer that gives you control without the operational exposure. Let's say you own three companies, one in logistics, one in tech, and one in consulting. Instead of owning them all directly under your personal name, you create a holding company. This holding company becomes the shareholder of all three. You'll still control everything, but now through a central protective layer. The same applies to real estate portfolios, intellectual property, or investment holdings. You're not running the businesses through the holding company, you're holding ownership of businesses themselves. And that distinction is very important. Now, here is where it becomes especially relevant for wealth planning. When you hold all your assets personally, you expose them to your personal liabilities. A legal dispute in one area, even a divorce or unexpected creditor claims, could impact your entire portfolio. But with a holding company, you separate your ownership from operations. That legal firewall can be decisive. There is also a succession angle. If you pass away holding assets personally, your beneficiaries must deal with probate, inheritance laws, cross border tax filings, and all the paperwork that comes with it. But if those assets are held through a properly structured holding company, especially one that's paired with a foundation, transition becomes far more streamlined. Shares can be transferred without selling the underlying businesses or renegotiating each title. This brings us to another benefit, that is tax planning. While Dubai does not tax personal income, your global exposure might be more complex. If you are a non resident Indian, a South African, or Australian resident, for example, your foreign assets must be subject to tax back home. But when structured through a Dubai holding company, paired with proper advice, it may be possible to defer or even avoid certain exposures entirely. Of course, this depends on your residency, treaties, and reporting obligations. But for many, it's a significant optimization opportunity. Let's look briefly at the banking angle. Opening bank accounts in Dubai, especially when you're holding international assets, requires clarity. Banks want to see that your structure is legitimate, compliant, and purpose built. A Dubai based holding company with proper licensing, clear ownership, and clean books offer exactly that. In fact, many private banks prefer dealing with holding entities rather than personal accounts, especially when capital involved is substantial. Now, some may ask that why not just use an offshore company? After all, jurisdictions like BVI or Seychelles are cheaper and faster. Well, that's true, but they're also under scrutiny. Many banks now hesitate or outright refuse to open accounts for certain offshore entities. Dubai, on the other hand, offers a regulated, globally respected framework. You get the benefits of low tax and flexibility without the stigma of secrecy. Of course, not all holding companies are the same. You will need to decide between mainland or free zone or common law jurisdiction. For high net worth individuals, DIFC and ADGM remains the gold standard. Both operates under the English common law, both allows for 100% foreign ownership, and both are widely accepted by international banks, auditors, and legal professionals. You can also combine them with foundations or trusts for enhanced estate planning. Here is a simple example. An expat business owner sets up a DIFC holding company. That entity holds his shares in an African fintech business, a Dubai real estate SPV, and a brokerage account in Switzerland. Instead of having three different ownership routes and three potential risks, he now has one central structure. His Dubai Foundation holds the share of the holding company, providing estate continuity. And because it's all housed in a clean, audited jurisdiction, banking and legal compliance becomes much easier. Another case involves a European family office. They use a DIFC holding company to control equity in five different operating companies across Europe, the Gulf, and Southeast Asia. This way, distributions can flow up to the holding company and be reinvested or managed tax efficiently, depending on the treaties in place. But there are certain limitations. A holding company is not a magic shield. If you run operational activities through it, signing contracts, hiring staff, or engaging in trade, you expose it to risk. That's what we often advise to combine holding companies with separate operating SPVs. One entity holds the value, the other carries liability. There are also compliance requirements, annual filings, audits, economic substance tests, and these aren't optional. That's why the choice of jurisdiction matters. Dubai offers robust structures, but you still need to maintain them properly. And yes, there is a cost, but for serious business owners, the benefits far outweigh the fee. It's also important to get the sequence right. Don't rush to register. First, map out your existing ownership, then define your succession goals. Only then you should structure the holding company. We have seen too many clients try to fit the structure after the fact, which almost always results in extra complexity. If you already operate across borders or expect to in the future, a holding company is not just an efficient tool, it's a risk management tool. It gives you visibility, it gives you optionality, and it gives you the legal structure to protect what you have built. If you own a business or real estate, don't wait for legal or health crisis to start thinking about protecting your wealth. Many people think asset protection is only for ultra wealthy. But the reality is that some of these solutions cost as much as setting up a free zone company in Dubai. If you want to secure what you have built and ensure your legacy, you can request your free and customized asset protection plan by clicking the link in the description below. And if you're serious about building long-term financial security, you should really check out my next video right here.